Hello, and welcome back to Finance Speaks. I'm Kyle Sadler, President of Precept Wealth Management and best-selling author of I'm Retired, Now What? I'm here today to talk to you about a different funding source for long-term care insurance. Long-term care, or LTC, insurance is not something that many people usually think of purchasing while they are enjoying good health. The irony is that many people don't see the need to purchase it until they are faced with some type of health issue. But by the time it is too late to qualify for LTC insurance, this is because since traditional health insurance and Medicare do not cover all costs associated with long-term care, LTC insurance could be a viable way of bearing the cost for this when it comes time that long-term care is required. The cost of long-term care insurance may also be a deterrent to many. Nevertheless, there are clever ways to find the funds for LTC insurance. Through my experience, I have generally found that the ideal time to purchase LTC insurance is between the ages of 55 and 65. The ages when you may still be enjoying good health. This age range also may coincide with the very time that parents are reaching the age of requiring elder care or passing on. Whichever the case, the need awareness for LTC will be very apparent if you are faced with the tremendous task of caring for an elderly parent. The deterrents of why people generally avoid buying LTC insurance are usually retracted by the time and financial frustration of caring for their or their spouse's parent. Therefore, I throw out this strategy. Okay, before running out and buying that new car or other temporary articles of satisfaction, consider first the money that you receive from an inheritance could be used to fund your own long-term care insurance policy. Since one might receive a lump sum of cash through an inheritance, it may be a great idea to allocate some of those funds to funding this policy. One method is to purchase a single premium immediate annuity, or better known as a SPIA, for a 10-year period, and have the withdrawal going directly to the LTC policy. What if you don't have an inheritance or you know that there won't be one? When I'm doing planning on an employer-sponsored retirement plan, such as a 401k, I look at the possibility of rolling over part of the money to purchase that SPIA, which will then fund the LTC premium. Again, something to think about outside the traditional, I don't have money in my budget. As I have found, this strategy may be especially valuable for those who have had to fund the cost of long-term care for their own parents largely on their own, wiping out savings and creating financial mayhem. Wouldn't it be wise to avoid placing your own children in the same predicament by purchasing your own long-term care insurance when those funds are still available to do so? When faced with the grief of their parents passing and the financial devastation, many people fail to see the opportunity to stop the cycle and to ensure that their own children won't be burdened to meet the probable cost of your own long-term care. This method will definitely leave some positive tone for elder care in the final stages of your life, because this is how finance speaks. I'm Kyle Sadler, headed out until next time. Be blessed as you travel the roads of many journeys. We'd like to extend a special thank you to Cambridge Investment Research, Crump Life Insurance, Genworth Financial, and Mutual of Omaha for assisting with the research, information, and working with us for all of these years so that we could present this topic today.